So Opendoor released Q1 earnings last week, and despite beating analyst estimates, the stock sold off. So what went wrong? In this video, we'll go over Opendoor's recent earnings and find out whether it is a good investment at these levels. What is going on, you guys? Welcome back to my channel. My name is Riado, and in this channel, I analyze some of the most innovative companies in the world and help you find the companies of tomorrow. If that is something that you like to hear, don't forget to subscribe to my channel so you won't miss future videos. Also, if you like to read the article version of this analysis, you can find the links to my article in the description down below. With that said, let's get started. Alright, let's take a look at the growth numbers for Opendoor. Q1 revenue came in at $5.2 billion, which is up 590% year over year. This is a deceleration from the previous quarter of 1,436% year over year growth. Do note that 2021 growth rates were really high due to the fact that 2020 was a year where management was very conservative in terms of buying homes from consumers. That's why 2020 revenues declined a bit during the early days of the pandemic, and then it spiked in 2021 as the company becomes more comfortable buying and selling homes. But Q1 revenue of $5.2 billion is still a very large number. It is an annual run rate of $20 billion compared to 2019 full year revenue of just $4.7 billion. So that is a strong testament to Opendoor's value proposition and how fast the company is scaling and capturing market share. So revenue increased due to increasing adoption of digital home buying and home selling. Revenue also increased due to higher price per home sold, driven by HPA or home price appreciation, which increased 34% year over year. And lastly, the company also expanded to 45 markets compared to 2021 Q1, which only has 27 markets at that time. In terms of the number of homes purchased, the company purchased 9,000 plus homes, which is up 151% year over year. This is due to a record number of seller offer requests, which is up 186%. The company also maintained a net promoter score of 80 plus, as well as a 35% real seller conversion rate. On the other hand, the company sold more homes than it sold, which is 12,669 homes, which is up 415% year over year. This is due to record purchase offers, as well as the recent launch of Opendoor backed offers and Opendoor Complete, which simplifies the process of home buying using Opendoor. You know, I was actually really concerned with Opendoor buying way more homes during the better part of 2020 and 2021, as you can see by the dark blue bars right here. However, Opendoor reduced the number of homes that they purchased from consumers and subsequently increases the number of homes sold to them. This shows that the company is not only a platform for people to sell homes, but also a platform to buy homes as well. And this is important because it shows that Opendoor is a two-sided marketplace for home transactions and not just for selling homes. Now, because the company sold more homes than it bought, homes in inventory dropped quarter over quarter. However, it is still a 352% increase year over year. The company has 13,000 homes in inventory valued at $4.7 billion. So I think the numbers speak for itself. You know, the company is growing rapidly. It is taking market share. It is, consumers are coming into the platform and using its products and services and loving it at the same time. So I think the trend will persist. The company will continue to gain market share and continue to grow moving forward. So turning to the profitability of the company, Opendoor recorded $535 million of gross profit, which is up 452% year over year. Gross margin is at 10.4%, which is a improvement from the previous quarter of 7%. However, it is not as high as last year's gross margin profile. This is due to very low inventory due to the early days of the pandemic, as well as very high HPA, which is why there's excess margins during the during this period right here. So gross margins improved sequentially due to two reasons, and that is normalization of Opendoor's inventory mix as well as higher fees to consumers. So the company mentioned that they started to increase spreads or increase fees to consumers back in Q3 to combat market volatility and market uncertainty. And while increasing spreads or increasing fees will significantly reduce demand for Opendoor's products and services, the company is seeing things differently. So as you can see, during the Q1 earnings call, CEO Eric Wu mentioned that increasing spreads have not seen a material damage to conversion rates. And he also mentioned that during this time of uncertainty and market volatility, Opendoor is creating the most value during these times. So I think this is where Opendoor's value proposition really shines, as it gives consumers simplicity, convenience, and certainty in terms of transacting homes. So therefore, conversion rates should remain steady despite increasing spreads. So contribution profit margin after interest, which is how much the company makes per home sold, is about 5.6% in Q1, which is an increase from 3.3% in Q4. The company makes $23,000 per home sold, and this marks 21 consecutive quarters of positive contribution margin for Opendoor. I think this is an outstanding achievement given the market volatility that we've seen over the last few quarters, and it shows a lot about Opendoor's technology and pricing model as well as its value proposition during this tough market environment. As a result, the company achieved GAAP profitability for the first time ever in its history as a company. The company had GAAP net margin of 0.5% and operating margin of 2.3%. However, I like to look at adjusted net margin, which accounts for non-cash expenses such as stock-based compensation as well as inventory value adjustment. So adjusted net margin is 1.9%, which shows improved earnings potential as well as economies of scale and operating leverage. I think this is very encouraging to see, and I expect the company to gain economies of scale and improve margins over time as they spread fixed costs over a larger number of homes sold. So turning to the balance sheet, the company has $2.8 billion of cash and short-term investments. Total debt is at about $5.8 billion, which makes their net debt position to $3 billion. The company also has financing capacity of $11.3 billion, which makes it $35 billion plus of annual home purchasing power based on typical inventory turnover rates. The company also has a current ratio of 3 times, which is quite healthy in my opinion. So as I mentioned earlier, the company has 13,000 homes in inventory. However, the company expects this to be the low point for inventory for the year. So we can expect the company to build up inventory throughout the year as well as over time as the company scales. However, I think a lot of investors are pretty concerned with the fact that the company is holding more inventory, especially in an environment where there's rising interest rates, slowing housing demand, as well as market volatility. However, I do not see any major challenges as the company focuses on short duration, high velocity, highly liquid assets that are sale ready, and therefore they're able to sell homes at a much faster pace than the overall industry. As you can see here, Opendoor typically holds inventory for 3 to 4 months compared to the rest of the industry, which takes 9 months to 84 months. And also management mentioned that only 7% of their homes were listed on the market for more than 120 days compared to the overall market of 24%. So in case of a housing recession, I think there's limited downside exposure as Opendoor is able to sell their inventory very quickly. So free cash flow is about $1.5 billion in Q1 at a 30% margin. Free cash flow continues to be very volatile as the company is investing heavily into growth. But over time, I expect free cash flow to really stabilize as the company balances between home selling and home purchasing. Management expects long-term adjusted net income margin, which is a good proxy for free cash flow, at about -2% to 4%. So turning to the company's outlook, management expects Q2 revenue to be between $4.1 and $4.3 billion, which is about 354% growth year over year. The company also expects adjusted EBITDA to be about $180 billion, which is a 4.3% margin and 604% growth year over year. And lastly, the company expects stock-based compensation to be in the range of $73 to $75 million. And also, management gave out the following market outlook. They expect moderation in HPA and transaction volumes beginning in the second half of the year. And so we can expect Q2 margins to be in line with Q1, and it should taper down as we proceed to the second half of the year. And so in anticipation of a slower HPA and transaction volumes, the company is positioning itself to be more conservative in its home valuations given general macro uncertainty. I think one of the biggest concerns for Opendoor investors today is the fact that the real estate market has been really hot over the last few quarters and years, and therefore in this new environment where interest rates are spiking and mortgage rates are spiking, there's going to be a slowdown in housing demand, and therefore a lot of people are anticipating a housing crash or housing recession. And because of that concern, management provided a comparison between the current housing macro environment and the global financial crisis in 2008. So the difference between the two periods is that today market inventory is at a 40-year low, which is approximately 72% lower than in March 2008. Consumers are also in a much healthier position. Household financial obligations as a percentage of personal disposable income is also at a 40-year low. And last but not least, real interest rates remain quite low on a historical basis at around 2% compared to a pre-pandemic average of 2.5% and a pre-GFC average of 4.5%. I think what management is trying to say is that, there's going to be a slowdown in the housing market, but it's not going to be as bad as many people think. And furthermore, real estate prices move very slowly in market declines. Over the last 50 years, there's only 6 quarters with 1% or less HPA declines, excluding the Great Financial Crisis. And even during the Great Financial Crisis, the worst quarterly drawdown was only 3%. And remember that the company typically holds inventory for 3 to 4 months, which is about 1 quarter. So therefore, Opendoor has limited downside exposure in terms of the price of homes that they can sell. Now, turning to the valuation of the company, Opendoor has price to sales ratio of 0.3 times, which is extremely low in my opinion. The company has traded as high as 6 to 7 times in terms of price to sales. Now let's take a look at analysts' expectations in terms of Opendoor's revenue in the next few years. Revenue is expected to grow 127% this year to $18.2 billion and is expected to continue to grow until $66 billion by 2031. But this is a pretty conservative estimate in my opinion, but let's just say the company is able to achieve $66 billion by 2031. So if we go back to this chart right here, the company has 0.3 price to sales ratio, and if we just keep that unchanged for the next 10 years, and if the company achieves $66 billion in revenue, that would mean that the company has a market cap of $20 billion. Today's market cap is about $4.19 billion, which means there's a 5x upside potential for Opendoor investors. That is, of course, assuming that price to sales ratio stays at 0.3 times. What if the price to sales ratio returned to the average of about 3 times? So if we take the $66 billion of revenue by 2031 times the price to sales ratio of 3, that is a $200 billion market cap, which is 50x from here. But let's just be very conservative and let's say it just returns to, to a price to sales ratio of 1. That is still a 15x from here. So what I'm trying to say is that Opendoor is severely undervalued in my opinion, and I think the risk to reward is very attractive for investors at the moment. So what is my investment thesis on Opendoor? As you can see here, this is what I wrote, I think 2 or 3 months ago. I wrote, Opendoor aims to empower everyone with the freedom to move by building a two-sided marketplace for home buyers and sellers. Through its dynamic AI-powered pricing model, Opendoor offers convenience, simplicity, and certainty which consumers have grown to love. It is operating as a virtual iBuying monopoly in a massive industry with low technology adoption, and the company is rapidly taking market share. And after seeing Opendoor's Q1 results, my investment thesis has not changed. The investment thesis remains intact, the growth story remains intact, and I believe Opendoor is still a wonderful opportunity for investors at the moment. I don't know where Opendoor stock is gonna end up in 6 months or a year, but I'm pretty confident that Opendoor will be valued much more higher than it is today in the next 5 or 10 years. And despite beating analyst estimates, the stock sold off, and I think it's because of very negative market environment that we're seeing today. And as for me, I'll ignore the noise and continue to focus on the business and continue to accumulate shares at these price levels. Well, that's it for me today, guys. Thank you so much for watching this video. If you're interested in watching my Opendoor deep dive or any other companies, you can click in this playlist right here. And yeah, thank you so much for watching this video. I'll see you guys on the next one.